Good morning, everyone. I think that's now 11 o'clock. The webinar has just started, and so I think we'll kick off. So good morning to everyone who's joined us this morning. It doesn't seem 12 months ago since Owen and I were here live or stood live talking to you, sort of anxiously awaiting details of a lockdown or being told to go inside and hide. And what a strange year it's been. We can now hopefully see the light at the end of the tunnel. And Owen and I are both very keen to get back to the live updates next year, not so much for the early start, but definitely for the food.
Absolutely. And the other thing which would be great to do that is, I think, our Whitney update after the last budget was probably the last time I greeted anybody by shaking hands with them. So we'll look forward to getting back to a bit of normality like that at some point.
Absolutely. So for anyone who hasn't joined us before, I'm Ian Parker, Director at Whitley Stimpson. I'm joined by Owen Kyffin, who's also a Director with me here. We will try and steer you through yesterday's budget and give our insight into what we think that means and the impacts for you and your businesses. This is our first webinar together, so please do bear with us. I think we've been organised very well by our marketing team, but you're never quite sure with these things. And just a little bit of housekeeping, we will be taking questions or have a question and answer session at the end. So please do use the Q&A functionality within the Zoom webinar. And we will open those at the end of the presentation and try and work through as many as we can. The aim is that we will talk to you for probably an hour and a half or so, and then have 10-15 minutes for questions and see you on your way ready for lunchtime before 1 o'clock. So we normally sort of start with what sort of a budget was it for you? And I think, I mean, really the general consensus was it started to show us the road to recovery. And I think for most people, they were probably largely unaffected by yesterday's budget. The sort of draconian tax increases that had been mentioned in the press for the last 5-6 weeks didn't come to fruition, although we will come on to talk about the change to corporation tax. But I think it was very much a steady the ship budget. The only real people who I think might have had their head in their hands are the conveyancing solicitors. Owen and I were talking to some solicitors on Tuesday, and they said the conveyancing team are working all hours, and actually a further extension of the stamp duty reliefs might not be welcome. Because I think they're pulling their hair out a little bit. So we imagined that there might be a few conveyancing solicitors that looked a little bit like this yesterday. So again, what were we expecting from the budget? I think we've all seen the reports in the press, particularly around the sort of the end of January time. There were a lot of reports that capital gains tax was likely to be increased and possibly aligned with income tax. I think whilst that was quite an easy story for the papers to run with, the practicalities behind doing that are actually quite difficult. By their very nature, income and capital gains are very different. They're very different taxes and arise on very different assets. So I think aligning those would have always been very difficult. But notwithstanding that, we did talk to several clients and actually have done some transactional work since the turn of the year in anticipation of a possible rise to CGT rates. But thankfully, no major changes in that arena. I put the coronavirus job retention scheme there because Owen actually texted me the night before, because it seems that the Treasury have started to leak some information now, sort of 24, 48 hours in advance, which they haven't usually done, Owen.
No, I think there's stuff that was good news that I think they were keen to get out there a bit in advance. So we were aware of a couple of things, but Actually, yes, it didn't kind of quite turn out the way we were expecting, and maybe wasn't as horrific for personal and individual taxpayers as we had feared it might be. But, well, there's still time for that if Mr. Sunak keeps spending money as he's thankfully been doing.
Absolutely, absolutely. We'll wait and see. We might return to the autumn budget and be doing this again in 6 months' time, yeah?
Yeah.
So, as I say, what were we expecting? We've sort of talked about the capital gains tax rate increases there. I actually feel, and I must admit, partly being lazy, but this slide I haven't really changed from the last time, because we've been saying that these changes might be coming for several years now. And each time Owen and I sit here and we think we've got away with it again, I do wonder how much longer that will continue. So, further changes to BADR, that's Business Asset Disposal Relief, which was formerly Entrepreneurs Relief. Still not entirely sure why they changed the name, presumably just for some added confusion. We've talked about whether they might really remove pension relief at marginal or higher rates. Again, it's still perceived as a very valuable tool contributing into a pension. And we did wonder whether that might be something that they brought in this time, but seemingly nothing of that. Also, inheritance tax. We were very well aware that there had been a complete review by the Office for Tax Simplification. Yes, there is such a thing. Over the last sort of 12, 18 months, and they'd come out with some quite significant inheritance tax change suggestions. But seemingly they've gone under the radar and unnoticed again. So no news is good news, and the debate rumbles on with national insurance and trying to get parity between those who work through a company and employees, and
I think that's indicative that the Chancellor's just taken a light pedal approach with this budget. I think it's too early for him to go crashing in and doing all sorts of things, because everything's still in a very delicate state. But he said quite unambiguously that he was going to try and level things up between, for example, the employed and the self-employed, and possibly those who run their businesses through limited companies and take dividends. So, although no changes in national insurance at this point, I wouldn't be surprised if a couple of years down the road we maybe saw some.
No, absolutely, and I think again, just picking up on it now, because we don't really cover it in much detail later on. No changes to national insurance, which could have been a real boot to directors of their own companies, along with the fact that there's still no real sort of grant schemes in the same way that self-employed people get the income support scheme. I had seen a director's income support scheme mooted sort of through Parliament over the last 4 or 5 weeks, but no mention of it here. So perhaps he decided, we're not going to give them the grants, but we're not going to kick them whilst they're down with the national insurance changes at this time as well. So what did we actually get? As I say, it's very much a roadmap. I think the general feeling was it was a fairly, as Owen said, light touch, steady the ship budget that was announced yesterday. As always, the devil is in the detail, and that's really what we're here to do today. We've had a chance to go through what information HMRC have published, and that isn't all of it by any stretch, but we have seen the bits they've put out, and we've tried to pick out the key points for you, and we'll take you through that today. So I think Owen's going to kick off with sort of what the paper's picked up on, and the headline.
The headlines, which we've picked out, which we will go through in more detail, but just to alert you to what the headlines coming up are. Corporation tax rates are to increase in 2023, throwing the burden of the initial and extra tax gathering on businesses, freezing of personal allowances and tax bans, the extension to COVID-19 schemes of support, the freezing of VAT thresholds, the extension of business rates relief, and of course, the Chancellor's white rabbit out of his hat, the super deduction, but we'll take a rain check on that and come back to how super we actually think it is when we get there.
Absolutely. Build the suspense, Owen. We have put in a quick slide here because you'd seen a tweet, hadn't you, yesterday?
Yeah.
Is it a bird? Is it a plane? No, it's super deduction. So, yes, as we say, keep you in suspense, and Owen will pick that one up later on. In terms of what else was hidden in there, there's going to be a consultation on R&D tax credits, which could be good news. We're not quite sure, having read what the consultation will cover. I've put there corporation tax loss relief rules, and actually that applies to income tax as well. There's some quite significant changes to what you can do with loss relief. VAT reductions, confirmation of the IR35 provision rollout that we were aware of, and then the usual confirmations of rates and allowances for 2021-22, but also for the next few years, as we'll come on to cover.
So corporation tax rate changes, which I mentioned a moment ago, they're staying at 19% for 2020 until 2022. They then increase for very profitable businesses with profits in excess of 250,000 to 25% from the 1st of April 2023. There's a protection there for smaller businesses. Where the profits are less than 50,000, they'll continue to be taxed at the current rate of 19%. And then for the marginal rate between 50,000 and 250,000, there's a marginal calculation that will need to be done. And those of you that are as old as me will remember these. Back in the days when we had a top rate, I think, of 35% corporation tax, and they were very complicated calculations. I always hated them. I thought it was great the day they disappeared. So I must say I'm not relishing them coming back. I did pull one of our trainees' legs yesterday, saying that something he had to look forward to was the return of these marginal rate calcs coming back. They'll also cause issues, making the calcs even more difficult and complicated for companies that have an accounting period which spans the 31st of March 2023. And we haven't seen the detail of the draft legislation as yet, but when we had different rates for corporation tax before, these bands were divided by the number of associated companies. So it will mean we need to be a bit more careful with groups of companies, not maybe create them willy-nilly, and we'll need to be a bit more careful planning where the profits fall within the group to make sure we're making the best use of the bands. But we're used to that. It's what we used to do. We've maybe ignored it for a few years, but we'll soon get back into the habit of it, hopefully.
Absolutely, and as you say, Owen, it's really the reintroduction of the small business rate by another name, isn't it?
Exactly.
And Owen and I also found this. We've put the picture up there. It's quite interesting that it's a complete U-turn from the manifesto sort of campaign that the Conservatives ran, which was actually, they were saying every time you to stimulate growth within a country, you actually cut corporation tax. Well, they've gone the other way here, so we wonder what's changed their mind a little bit.
So they've said there's going to be a consultation on our research and development relief for tax purposes. Just a quick overview of where we are now. We've got two forms of the relief at the moment. We've got the small and medium-sized enterprise relief, the SME relief, which is 130% of your spend. So if you spend £100,000 on qualifying research and development, you get a tax deduction for £130,000, which is jolly nice. Early stage businesses, it's really useful too in terms of cash flow, because if that tips you over into making a loss, you can surrender that loss for a repayable tax credit. So it's a really useful tool to us. Then you get the RDEC for large companies. There's the RDEC tax relief, which is a 13% credit of your qualifying spend, but that goes in above the line in your accounts. So it's taxable currently at 19%. So the 13% in reality is 11p in the pound that you're actually getting tax relief on. As Ian said, we're not absolutely sure at this point what the consultation is going to cover, but at the moment the relief is available on consumable costs and salary costs principally, but there was some suggestion that they might expand that to include data and cloud computing costs being eligible. And there was some suggestion they might be looking at it to see whether we just have a single scheme in place. So maybe combining the two. And perhaps it will be the more generous way which they're going, because a lot of the constraints on how generous the reliefs could be in the past have been imposed by EU state notified aid regulations. Well, of course, now we're no longer in the EU, we're freer, although not entirely free of those. And I think they also were discussing the possibility of a separate system which is outside of the corporation tax returns. So it's really a case of watch this space and come and talk to us if you think you might be carrying out qualifying R&D, because there are already some generous reliefs there. And hopefully, given the tone of the Chancellor's speech, where he was pushing very hard how successful our vaccine research has been and how this might give us a competitive edge. Now we're on our own in the marketplace, as it were. I think this is an area they will be looking at very closely.
Absolutely. I think you've hit the nail on the head there, and I know you and I both get nervous when we see consultation and R&D together, because it is such a valuable relief. But I certainly, in reading what they'd put out yesterday, I didn't get the feel that they were sort of looking to close it down or remove it. It felt actually very positive. So hopefully we'll see the continued investment over years to come. I'd really left this slide in about business asset disposal relief, BADR, just to say it's still there, which is really the key point. We did wonder, so you'll remember that sort of over the last few years, the lifetime allowance has reduced from £10 million to £1 million. And what the effect of this relief does is that if you have capital gains arising on certain disposals of business assets, it enables you to tax the now first £1 million of those gains at 10% rather than the usual rate of capital gains tax, which is 20%. So again, it is a very valuable relief. It's something we've seen used over the years with, particularly with farmland and sales of companies, that actually it can offer significant capital gains tax savings. I think really what we wanted to highlight here was that this was a budget light in terms of capital gains tax, despite what we thought. This is still there, so it might actually be that now is the time to act and just consider and possibly just have a chat with us. If you're thinking of disposing something, selling a business, then now might be the time to push on with that and just pick up the phone and have a chat with us. This was the real relief point for Owen and I, because again, we'd seen so much, and we've seen so much over the last few years, that pension relief might well be removed. No news is good news. They didn't touch upon it at all. The annual allowance is still £40,000 for the majority of earners. You do have to be very careful if you are a very high earner, and I'm not going to dwell too long on the differences between threshold income and adjusted income, but very broadly, adjusted income is your income for the year, be that through employment or self-employment or dividends, plus the amount of pension contributions made on your behalf by an employer. So again, it's really an anti-avoidance measure so that people can't surrender huge amounts of their salary into a pension and avoid falling foul of this rule. If you do fall into this category and have income or adjusted income above 240,000, then they actually reduce the amount that you can put into a pension and claim relief on, down from the maximum of 40,000 down to actually just £4,000. Whilst that sounds fairly horrendous, actually Owen and I were sort of talking about it yesterday, and we came to the conclusion that actually for the majority of people, if your decision is, do I put this money into the pension and pay the pension's annual allowance charge, which is at 45%, or take this or effectively have this as additional employment income. Perhaps you might be saying to your employer, well, hang on, only put 4,000 in, but pay me the what you would have put in as a salary. If you have it as a salary, you're going to be paying national insurance on that, albeit at 2%, but it's still a cost. So it might still be the right thing to actually put more into the pension and just take the annual allowance charge, but it just needs planning for, so that you're not hit with any nasty tax surprises when your tax return goes in the following January.
Right, this is a quick rattle through the final part of the budget, which was the coronavirus support. Just the headlines, which we'll break down the detail of a little bit later on. The furlough scheme's been extended, which, as Ian said, they pre-leaked really to the press. The self-employed income support scheme, there's going to be 2 more rounds of that, he announced yesterday. Still nothing for people trading through limited companies or people who just slightly fall foul of the self-employed income support rules, but no changes there. Business rates relief has been extended. There's some grants for non-essential shops and services when they try and get up and going again. And there's a new recovery loan scheme with the intention of stimulating businesses and the economy once we all escape outside our 4 walls again. But as I say, we'll be covering the details of those later on.
Fantastic. So for those who have joined us before, as you've no doubt got used to, I will take you through the changes to personal tax and savings. So really the highlight here was that there were no changes to dividend taxes. Again, I find myself repeating it, but no news was very good news yesterday. I think probably the coronavirus pandemic last year highlighted the differences in the tax system between those who perhaps operate their own company and take their remuneration by way of dividends and the salary, compared to those who are employed, and how much additional tax they pay. We had thought that they might start to try and align the tax rates for dividends and for employment income, which for basic rate taxpayers, dividends are taxed at 7.5%, whereas for basic rate employed individuals, that employment income is taxed at 20% plus national insurance of 9%. So there is quite a gulf there. But as I say, there were no changes, so I will come on and cover the detail of the dividend tax rates in a couple of slides' time. But the good news is that it's basically staying as it is. This was really a headline, and it applies to both income tax and corporation tax. So you'll see a very similar slide in Owen's section on corporation tax in a little while. Ordinarily, for income tax purposes, if you make a loss in a particular tax year, you can carry that loss back 12 months. So you can usually use it against profits from the same trade, looking back just to the previous 12-month period. What they've said this year is, because actually large numbers of individuals, self-employed or partnerships with individual partners, have actually made some significant losses because of the pandemic, you can now carry those losses back for 3 years, for up to a maximum aggregate carryback £2 million for the, if you like, preceding years 2 and 3. So it's still unlimited for the immediate prior year. So if you've made a loss, hypothetically, of £7 million, and you'd made 4 million of profits in the prior year, you could still carry 4 million back to the year before, and then you've still got 2 million spare that you can take back even further. I think in reality, I mean, we're talking such big numbers here. I'd be surprised if we see many people who exceed or have losses exceeding the £2 million to carry back. I think if you have had a loss of that much this year, then you probably actually need more structured business advice rather than just being able to carry the losses back. As Owen just mentioned, there's been an extension to the self-employment income support scheme. They've announced the 4th and 5th rounds of funding, and this is a scheme that has been very widely taken up and I think been very welcome for those who were eligible, but seemed unfair, particularly when it was launched in April 2020, to those who perhaps were newly self-employed and hadn't filed a tax return previously. So in a bid to try and address those issues, the Chancellor has tweaked the criteria slightly for the 4th round of funding, which means it's opened up to approximately 600,000 more people. And you can now look at anybody who, as of midnight on the 2nd of March, had filed their 2019-2020 tax return. Underlying the same criteria then still is in place. So if they had profits of more than £50,000 or average profits for the last 3 years of more than 50,000, then they're still not eligible. And you do have to be continuing to trade and be impacted or have been impacted by COVID-19. So I think we will see some more people claim. I know I've certainly got a number of clients who were newly self-employed that this will be a very welcome relief for. For the 5th, well, the same levels apply. So you can claim a maximum of 80% of your monthly average profits for the next 3 months, up to the £2,500 per month cap. So maximum for the next 3 months is still 7,500. That is worth pointing out that there was actually some very techie, boring legislation also announced yesterday, which just means that any amounts received from this point onwards will now be taxed on a receivable basis. So anything you got up to this point will be taxed on your 2020-2021 tax return. And I think they're thinking that anything then received in the next tax year, it will just be on a receivable basis as this rolls out. The 5th round, which is due to start much later in the year in, I think, July, has been announced, and that has turnover conditions attached to it as well. So in order to qualify, it will be the same previous conditions, but you must also have seen a 30% or more drop in your turnover. And I think Owen's perhaps got a practical sort of warning point on these that he's come across on either on some of his clients or he's heard about in the tax world.
Sorry, Ian.
No, not at all.
Yeah, it was just that we'd seen the last week or so coverage coming out of people who'd been involved in the previous rounds of the self-employed income support scheme starting to get letters of inquiry from HMRC, just trying to make sure they really had a decrease in their trade or a problem to their trade presented by the pandemic, and making sure that they really are entitled. So it might just be worth reflecting on that when you're formulating your claims, or if you've already made any claims, and just talking it through with your accountant if you've got any concerns, because it does make clear their intention that they are going to look at this stuff retrospectively.
Absolutely, and we've seen the same thing on the employment taxes side with the furlough income, haven't we? You know, but there have been a number of quite high-profile cases where people have claimed furlough income that perhaps shouldn't have done, and HMRC are taking this seriously. And I think that unless you've seen otherwise, Owen, at the moment, I haven't seen that it's sort of industry specific either. They just seem to be almost randomly targeted, just asking people just to prove that they've been caught by this. Yeah,
I think that's correct.
So we're then on to the sort of confirmation of the allowances. So this was, I think, something that was really a headline, and this is the biggest, this is the biggest single change that will affect the majority of people in the UK, which is the personal allowance. They had announced last year that the personal allowance would rise each year of the Conservative government by the CPI rate. So we were expecting fairly small but inflationary increases to keep it as a constant. They've kept the 2021-22 increase, which sees the personal allowance go up from £12,500 to £12,570. But they've now announced that that band freezes until the end of or the 5th of April 2026. So while software developers will be, I'm sure, very happy because they don't have to continually rewrite the tax calculations each year, I think that the plan is this is going to actually drag quite a number of people actually into paying some tax. So if you're a lower earner, then clearly if this personal allowance, which is the amount you can earn tax-free, isn't increasing in line with inflation, but perhaps your pension or your employment income is seeing these inflationary increases, you are going to close that gap and may start paying tax. And the same can be said when we look at the actual bands. They have also decided to freeze the bands, which I've got just here. So we're seeing an increase up to 37,700, meaning that you can earn up to just over £50,000, £50,270 before paying higher rate tax next year. But that again is going to be frozen. So I think from what the Chancellor and the press I've seen this morning have said, that is going to drag a significant number of people into higher rate tax over the coming 5 years. So this is perhaps a bigger revenue generator for HMRC than it first appears.
I think that's very true, Ian, and I think it's very understandable and actually makes a lot of sense, even if it's not welcome. The easiest way for them to have got quite a lot of money into the coffers quite quickly would have been to stick 1 or 2 or 3p on the basic rate of income tax, because that's the thing that almost everybody who is working pays. But it just would have been a PR and press disaster for them, because they'd have broken a manifesto pledge, and it's an easy headline for the papers. But this, in a way, has the same effect, because it will drag people into the higher rates who otherwise might have escaped. And as the personal allowance doesn't increase, they'll be getting that bit more income tax from people over the next few years. So it makes an awful lot of sense to me, even if we're none of us terribly happy about it.
No, absolutely. But and I was very pleased, just on an administration point, I was very pleased to see that they did stick with the planned increase for the 21-22 year, because I know they've been sending out all of the coding notices over the last 6 or 8 weeks, and it would be a real pain if they had to reissue all of those, and we were checking coding notices round 2 before the tax year has even started. So in terms of the other bands, they've largely remained unchanged. So I think it's worth highlighting at this stage that the rate at which you start to see your personal allowance disappear has remained at £100,000. So for every £2 that you earn over 100,000, your personal allowance reduces by 1. So by the time you've earned just over 125,500, you you have effectively lost your entire personal allowance, and that band there, if you're earning between 100 and 125,000, is very punishing, and there's certainly tax planning that can be done around that. The additional threshold for income tax, which is the point at which 45% taxes kick in, has also remained at 150,000. So that hasn't increased by the CPI or RPI. So again, that's just really a confirmation of what we were expecting. The rates of tax then for dividend taxes, as I say, very good news, no changes, just confirming here that you can still earn £2,000 worth of dividends tax-free, covered by the dividend allowance each year. That's really been put in place for occasional investors who perhaps have fairly small share portfolios, such that they didn't suddenly get caught and get taxed on relatively modest levels of dividend income. Once you've exceeded that, if you're a basic rate taxpayer up to the 50,270, you will pay tax at 7.5%. You've got then, once you've reached that threshold, you've got the 32.5% rate, and then, as I say, if your income exceeds £150,000 a year, then that rate rises to 38.1%. So it's really just considering how your dividends fit in with your other income, and making sure that everything is structured as efficiently as it can be. And that's really just some of the key sort of tax planning that we do. And I think we're going to see over the coming 12 months probably more conversations along those lines, and considering the interaction with pension contributions whilst the relief is still there. I always tend to mention the married couples allowance, the marriage allowance, which is where you can transfer some of your, if you don't pay any tax and your partner pays tax or spouse pays tax at the basic rate of 20%, then you can transfer 10% of your personal allowance. Please excuse the typo in this slide. The amount you can transfer has actually risen by £10 to 1,260 for next tax year. It's quite a valuable saving, and you can actually go back and claim for a number of back years. So again, where things are perhaps a bit tighter because of the pandemic, if you can claim a refund of perhaps £1,000, it's definitely worth looking at and worth doing. But please do give us a call if you think you might be affected by that. I've already covered the higher and the additional rates and the loss of the personal allowance, so I won't dwell on that any longer. Personal savings, I think the boring bits are really on the slide there. So the ISA allowance has remained at £20,000. The annual subscription limits for junior ISAs and child trust funds has remained at £9,000, which that saw a hefty increase last year. It went up basically by 100%, from 4,260 up to £9,000 that you could put into a junior ISA each year. I always issue the same cautions with that money put into a junior ISA does automatically become the property of the child when they come of age at 18. And clearly, if you've saved the maximum at £9,000 a year for 18 years, that is a very significant fund. So you might want to think about other ways to just protect them and protect that money, if that's something that you are considering doing or are able to do. I'm afraid I didn't put notes on here, but I did just want to highlight, because the Chancellor did make a couple of other announcements in relation to personal savings and tax. The launch of the National Savings and Investment Green Fund, that's for people who want to save, but want to save with a social conscience, where they feel they're investing in funds or projects which help with climate change, etc. So we don't know the full details of the rates on that yet, but it sounds as if they might beat the high street banks. and those funds open in June 2021. So they're one to watch out for. And the other thing that we saw extended, which was due to end on the 5th of April this year, actually, is the social investment tax relief, which is if you make investment into certain social projects, charities, then there was you could claim 30% income tax relief in the year you made that investment. And if you then held onto the shares that were issued to you for 3 years' time, they became capital gains tax free on sale. As I say, that was due to end on the 5th of April this year, and they've extended the scheme until the 5th of April 2023. So I think what we're seeing here is perhaps an underlying current from the government that's saying we're really going to try and encourage people to invest in green technologies. That's then seen with the consultation and possibly widening the scope on the R&D side, and the changes they made last year to electric vehicles as company cars. And alongside that, try and encourage people to invest in social enterprises as well. So I think they are trying to push back towards the green investment and community spirit. How successful it will be remains to be seen. I think that's me on personal taxes.
Thanks, Ian. Right, quick skip through corporation tax and business taxes now then. So we'll start off with a quick refresher on capital allowances and where we are at the moment. So we've got the annual investment allowance, which, if you recall, is the amount of your spend on regular plant and machinery that you can write off against your trading profits in year one. That's remaining at £1 million until the end of December this year. It then reverts to £200,000. You need to be very careful if you have a year end after the 31st of December, because you might, let's say you had a 31st Jan 2022 year end. If you invested £1 million in January 22, you might think, well, I can have 11/12 of that because it's in my allowance for the period up to the end of December. That's not how the calcs work. So if you are planning a big spend, it's well worth talking to us or to your tax advisors to make sure that the quite complicated computations will give you the level of relief that you're expecting. If you're buying under hire purchase, just a reminder down the bottom that the assets have to be actually on site and in use by your year end if you're going to get the allowances. Moving on to the Chancellor's rabbit. So he announced the super deduction, which basically gives you 130% deduction for main pool additions between the 1st of April 2021 and the 31st of March 2023. Main pool additions are kind of regular plant and machinery that, broadly speaking, isn't part of the building. If it's part of the building and it falls within certain classes, it can be reclassified as long life assets or integral features, and consequently you get a much lower rate of deduction. So in this example, if you bought a computer system for £100,000, you would get a tax deduction of £130,000, as opposed to ignoring the annual investment allowance, what would normally be an 18% writing down allowance. Similarly, I mentioned a moment ago integral features like fittings, heating, that kind of thing. Normally, you get a 6% writing down allowance for those. In this case, during this period, the super deduction will give you 50%, which is actually, in some ways, almost more attractive than the 130% in terms of the size of increase over what you would normally get. Having said that, I'm not convinced that people invest in plant and machinery and that kind of thing purely for the tax benefits. There's got to be the need there, but if you have got the need to upgrade and to kickstart your business by becoming more efficient, by having modern kit, this is going to be welcome. I was reading one estimate last night where it was a projection someone had done where a manufacturer spending 10 million on a new factory would be getting an extra £1 million of cash tax savings over the 2-year period that the measure's in place. One thing, as I say, to what extent people, it only applies to companies, to what extent this actually spurs people to go out there and spend, which is its intention. We'll just have to wait and see. The one thing I would mention, I'm not even going to attempt to explain them here, but if you qualify for this super deduction and then you sell the kit, the calculations for working out the balancing charge, which is the clawback of the allowances you've been previously given, is the stuff of nightmares. So just bear that in mind and talk to your tax advisor before you go ahead.
Absolutely. I think, just as I read through this yesterday, I thought initially I couldn't really see any real benefit because so few businesses spend more than £1 million annual investment allowance. But assuming that drops back down at the end of this year to 200,000, and this scheme then stays in place for a further 15 months, that's really when I think it might come into its own.
Yeah. Absolutely. So corporation tax relief, as Ian alluded earlier with income tax reliefs, there's an extension of the current rules which you can do, what you can do with losses. So for accounting periods ending between the 1st of April 2020 and the 31st of March 2022, the carryback of loss relief is extended to 3 years. The normal rules for loss relief are that you can carry it back 12 months against any profits of that preceding 12-month period, or carry it forward against future profits from any source. I always have to be very careful there because I spent the first 30 years of working in tax where you could only carry the losses forward against profits from the same trade, but that's no longer true. So I have to just watch myself there. So these new rules say that you can carry back for up to 3 years. There's a limit of £2 million, but similar to the income tax provisions, there's an unlimited carryback to the preceding 12 months. But once you go beyond that, there's the £2 million limit. The interaction of this and the increase in corporation tax rates could be quite interesting, because if you've got significant losses in your company and your cash flow permits and your forecasting is good enough, you might have to ask yourselves questions about, do I want to bang this back 3 years, or can I live with not getting the benefit of it for another year and getting tax relief on the loss at an extra 6%, being the difference between the 19% which you might get if you carried it back, as opposed to the 25% you might get if you carry it forward.
Absolutely, and I think just because of the timing that of the year ends that this affects, Owen, if it's year ends between 1st of April 20 and the 2022 year, it's possible that you've actually already filed your tax return, and so might be able to go back, amend it, and carry some losses back that you perhaps previously couldn't.
Yeah, and get some cash in your hand.
Yeah.
Which I think is probably the intention. Yeah, so that's something to look at. Diverted profits tax, I'll just mention in passing because this is kind of an obvious one, really. It's intended to stop people putting complicated structures in place to mean that they're taxed on profits that really belong in the UK somewhere else, which is likely to be a lower tax regime. So it's really to stop tax leakage from the UK to other countries. It was introduced in 2015. And it's currently at 25%. So it's 6% higher than the normal corporation tax rate as a discouragement for doing it. Well, obviously, if they're increasing the standard corporation tax rate to 25%, there's going to be no disincentive for trying to shuffle your profits offshore if the diverted profits tax is at the same rate. So it's increasing to 31% from the 1st of April 23 in order to make it mirror the relationship with the standard rate of corporation tax. And as I say, it's driven by the change to the normal rate, and it's designed to deter groups from diverting profits away from the UK. That's all I really need to say on that, I think. Oh, it's me again.
It is capital gains tax,
Capital
Owen.
gains tax. Yeah, this is a quick rattle through. Really weren't many changes to capital gains tax, but there's a few topical things we felt we should mention. So from April this year, the reporting deadline for the sale of residential property has been pulled back to 30 days for UK land and property. It's consistent with the non-residence regime that was there before, and great care is needed over whose responsibility it is for a number of reasons. The revenues online accounts aren't the easiest thing in the world. So you need to build in, given you've only got 30 days, you need to build into that a bit of irritation time trying to get the account set up, etc. You also need to decide who's responsible for that, whether it's the individual, the solicitor or the accountant, whether who's responsible for filing the CGT. But the real nuisance of it is is that the client is the person that's got to initiate the process and get it to a point where they can authorize us to take over. So you do have to have your ducks in a row. The other area where you really need to have your ducks in the row, because 30 days really isn't a long time, is if you're going to have a valuation included in your capital gains tax computation. Really need to make sure you've got that in hand and ready to go as soon as you complete, because as I say, 30 days whips by when you're trying to do this against the clock.
And I've seen two schools of solicitors as well, Owen. There's those who actually don't mention it, and we then perhaps get notified when we go to do the tax return the following year and find that the return is very late. Or there's actually those that are very proactive and will hold the money on completion to pay the tax and work sort of very closely with us. So yeah, it's always better if you think you might be caught just to actually line your solicitor up, because again, if they can hold the money and pay the tax that's due on your behalf, that's just that much easier for you.
Actually, and you've reminded me of one more thing anecdotally, Ian, that can be a problem with this, that when your client goes online to set up the 30-day CGT account, they will need to verify their identity with HMRC in the course of doing that. I just helped, he wasn't terribly old, gentleman, but he was older than me, so maybe he was terribly old. But he was of an age where he'd stopped his passport some years ago, and he didn't have a P60 because he was no longer employed, and they didn't seem to be picking up the P60s from his pension. So he actually couldn't set up his CGT account because he couldn't get over the ID hurdles which HMRC have built into their system, which seems to me a rather major failing of it. So he had to ring up a special telephone line and as a IT disenfranchised individual, get a paper return, which we could complete. But as I say, that took considerably longer than 30 days. I sent it off to HMRC the first week after Christmas, and I've still not heard anything. So yeah, do need to get your ducks in a row on that one. Right, capital gains tax rates. Well, gladly, at least for now, there's no change in the capital gains tax rates, which are 10% or 20% for most assets, with the exception of residential property, which is at the higher rates of 18% and 28%. The threshold is being frozen to 12,300 or 6,150 for trusts until 2026. So that's mirroring what we've seen with personal allowances and personal tax rates.
Absolutely. So thank you, Owen. I'm now going to move on to VAT. Again, they confirmed that the VAT registration threshold, which was previously frozen until April 22, is now frozen until 31st of March 2024. This is really, it's the parallel on the VAT side to the personal allowance freezer on the income tax side. HMRC are very well aware that there have been a large number of businesses in certain sectors that have been consistently trading at very, very few pounds beneath the VAT registration threshold for a large number of years. And just by inflation, they should now be breaching that threshold. And so by freezing it for the next 3 years, I think they're expecting to see quite a large number of people now having to register for VAT. And that really then is in line with their rollout of the Making Tax Digital scheme, which if you've been caught by, you'll be very well aware of the changes that you've needed to make and the fact that you're now having to hold records electronically, etc., and don't complete the VAT return in quite the same way as you would have used to. Clearly, this is still moving towards a driver for HMRC to be able to have more information available to them to see business trends, anomalies, etc. So I think this is quite a strategic plan to freeze this, and they are expecting to see a number of registrations going through. We've got as of the start of this week, actually, the VAT reverse charge for building and construction services. Now, if you're caught by this, I would hope that you are aware of it and that you have started to put something in place. I'm not going to spend too long dwelling on this because we have run a separate webinar covering just this topic, and that is available on our website and our YouTube channel. And I've asked Maria in our marketing department to send out the link to that webinar when she sends out the slides at the end of the once we've finished. But effectively what this is doing is where you've got two businesses or more that are involved in transactions within the construction sector, and that's broadly anybody who currently falls under the construction industry scheme. And again, you will know if you fall within that. When you invoice up the chain, if you like, you no longer charge VAT on that invoice, but instead put details on there to say it's subject to the reverse charge provisions, and the person buying those services from you accounts for both the output VAT and the input VAT. It's all part of a really sort of missing trader fraud clampdown from HMRC. I think they were concerned that people were filing the repayment returns and they weren't ever actually getting the output VAT. The actual provisions are quite horrendous, and even worse if you're using software. And we have actually just done some notes on software interaction and what tax codes to use as well. So I'm sure if you are impacted by this, do get in touch and we'll be able to help and point you in the right direction. This is quite a useful one. So the VAT registered businesses last year were given the opportunity to defer their VAT that fell due between I think it was about the 23rd of March and the 30th of June. To originally they were expecting to have to pay it by the 31st of March 2021. Clearly COVID didn't go away, so the COVID didn't go away, and so businesses are still struggling from a cash flow perspective. So the government have announced that you can defer the VAT that would have been you deferred last year, you can defer again over a further 11 months as a maximum. So if you want to take advantage of the full 11 months deferral, you have to manually opt in by the 19th of March 2021. And you make the first payment at that point, and then you pay in 11 monthly instalments following that. There is a sliding reduction of the number of months that you can spread it over until entries to the scheme finish on the 21st of June. But as long as you either pay the VAT that was due to be, that you deferred last year, or you set up one of these payment instalment plans, then actually it remains interest and penalty free. So it's quite a useful cash flow planning tool if you do want to spread it over 11 months on an interest-free basis. Clearly that's better than either paying it and it taking you into your overdraft or using a loan to pay for that. If you do nothing by the end of June, then unfortunately penalties and interest will be charged. So it's something that you really can't bury your head with. You do need to contact HMRC and set this up. It's a very straightforward online system to set this up, but unfortunately it's not something that we as your agent can do for you. Even if we file your VAT returns, because it's to do with payments, it has to be initiated by the taxpayer themselves. So as Owen said, we are aware that HMRC systems aren't always the most user-friendly, and please do let us know if you need any help with that. The confirmation from the Chancellor yesterday that the reduced rate of VAT of 5% that's been introduced will stay in place until the end of September 2021, clearly designed to encourage people to take some holidays, assuming that the roadmap out of COVID proceeds as planned and finishes on the 21st of June. That rate then increases for the 6-month period, October 21 through to March next year, up to 12.5%. I think if you're in this sector, I have every sympathy with you, because it will mean that over the course of 12 months, you will have had 3 different VAT rates for this sector alone. And actually, for those of us who prepare and file VAT returns, for the period, the 6 months to March 22, we will be contending with 4 different rates of VAT. We'll have 0 rate, the 5% reduced rate, a 12.5% rate for the tourism and hospitality sector, and then the standard rate of 20%. So do have some sympathy for us, because I thought they were simplifying taxes, but clearly I missed a memo somewhere.
Right, quick run through employment taxes now from me. So first up, furlough scheme. Anybody who's an employer will probably be familiar with the furlough scheme by now. I think unsurprisingly, announced the night before the budget, as a lot of people have been calling for, this has been extended through to the period, through to the end of September this year, to kind of ease businesses back out of lockdown, hopefully. It will remain at 80% throughout the scheme, which is the percentage the employee gets of their normal salary. That can, of course, be made up to 100% by the employer, should they choose to. But however, the difference on this occasion is that employers are going to be expected to make a contribution towards this. So if you decide not to top up, in August, 10% of that, of the 80%, 10% will be paid by the employer. And for September, 20% will be paid by the employer. I guess it's kind of easing people back into being used to paying their employees' salaries. As the Chancellor said, it's probably the most generous job retention scheme in Europe. But there's no further news on the retention bonus scheme, which we didn't see announced yesterday. Next up is consultation on EMI schemes. The Chancellor, although I'm not entirely convinced by everything he did, I like the tone of what he's trying to do. He's very focused on driving businesses forward once we come out of lockdown. So he's going to consult on whether EMI schemes are performing as they should be, and if there's a way of improving them going forwards. Just to give you a quick overview of EMI schemes, if you're not familiar with them, it stands for Enterprise Management Incentive. What it allows you to do is, rather than pay staff you see as key to the future development and growth of your business in cash, which detracts from the business's cash flow, you can give them a stake in the business going forward without any immediate tax cost. So you can say to them, you can have an option over 10% of the company, but you can't exercise that option until such a time as we make a trade sale or such a time as our turnover hits X. So it can be completely conditional, their ability to exercise the option. So yes, you are giving away some of your pie, but no, you're not giving away that pie until it's become bigger through the efforts of the particular employee involved. And the advantage of the EMI options are that if my employer gives me an option over shares that are worth £200,000 when I exercise that option, and I've only got to pay £100 for them, all bar £100 of that £200,000 value is tax to income tax at up to 45%. If you can get a qualifying EMI option in, firstly, providing the exercise price is the same as the value of the shares at the date it's optioned, any increase in value in the value of the shares that the option is over is taxed to capital gains tax at 20% rather than 40 or 45%, which it would be with income, because it's a capital gain instead. And similarly, whilst you hold the options, you can accrue entitlement to business asset disposal relief on them, which might even reduce that 20% down to 10%. So, as I say, nothing concrete yesterday, but they're going to consult and look whether, I think one of the things they mentioned was whether they might expand the scope of this, so it might be available to larger enterprises. The other thing they mentioned yesterday, well, we wondered whether Alan Sugar might be able to take on more than one apprentice now. They've doubled the current apprenticeship bonus incentive. So it's at £3,000 per new hire, regardless of age, between 1st of April 2021 and 30th of September 2021. They also announced portable apprenticeships. So if you take an apprentice on and he then moves job to another employer, the advantages gained by his apprenticeship aren't lost or surrendered. They announced a further 126 million of traineeship funding for businesses in England.
I would just probably add to that, Owen, as well, that the apprenticeship scheme now covers a far wider range of businesses and industries than I perhaps would have envisaged. I always sort of think back to fairly vocational places of work, but actually now large numbers of sort of professional services and advisors, etc., they're actually eligible for taking on apprentices too.
Yeah, absolutely, absolutely. We do see it far more widely used these days, and it's a good scheme, I think. And actually very relevant where people might be considering whether university is the right option for them, or whether going straight into the workplace is a better deal.
Absolutely.
Right, a quick mention of personal service companies, not because anything changed yesterday, but just because it's very time relevant. So IR35 and intermediaries legislation hasn't really worked as various governments have wanted it to since it was introduced. Broadly, it's where people are providing their services via an intermediary company, therefore not paying national insurance on their earnings from what they're doing, but rather feeding the profits of their company out to themselves as dividends, which historically had a much lower rate of tax, and even now has a marginally lower rate of tax, but dividends still don't carry employers or employees' national insurance. So the intention was, if you did that through your company and it really looked like an employment, you were supposed to pay the tax and national insurance as though you're an employee, which very, very few people did. HMRC's compliance history with it has been really rocky. They take a few cases a year and seem to lose more than they win. So there was a change was introduced from 6th of April 2017 for the public sector workers, passing the responsibility for taking that IR35 decision from the individual's limited company to the person they were contracting to. The thinking is obviously that, you know, the payroll departments of these big organizations are going to be risk averse and are going to make the compliance work better. That was supposed to be extended to the public sector from this time last year, from 6th of April 2020, but given the state everything was in there, the Chancellor back then said, oh, well, let's just kick it down the road for a year and we'll bring it in from April 21. So that is still happening this year. There's been no change, and the responsibility for decisions on the status has been transferred to the person receiving the services, from the personal service company. So that now applies to the private sector as well as the public sector from April, and it's up to the private sector employer, in inverted commas, who takes on the contractor, to feed the data on the person they're contracting with through their HMRC's portal to determine their status, and then to make sure pay as you earn is operated correctly if the provider of the services actually looks like they're an employee. Sorry, I've lost my crib notes here. There is a let out, though, for small companies, so that the responsibility for the status continues to rely with the personal service company. If it's a small company, which is defined as passing 2 of the 3 tests, turnover not more than 10.2 million, balance sheet value not more than 5.1 million, and average employees less than 50. As I said in my slide, we saw a lot of people go back onto the payroll when this was introduced in the public sector. So we may well see the same happening now. And then I think the final point was there was a small technical change where people providing their services through umbrella companies were potentially caught, but of course the umbrella companies are already operating pay as you earn. So HMRC wanted to make sure it was fair. So they've done a little tweak to facilitate, make sure umbrella companies aren't caught. So, final bits and pieces really here.
Absolutely, a quick wrap up of the other things that came in, not necessarily tax related. Business rates relief. So you'll all have been used to the 100% business rates relief that was in place for the current year, 2020-2021. That's actually been extended until the 30th of June 21. And then from that point, 1st of July through to the end of the 22 rates year, there'll be a 2/3 relief for the remainder of the year. So they really are trying to help kickstart business when things can open back up again. Just a minor point, really. I think I'm probably just a bit bitter as a true accountant. It's who's picking up the bill. I know that our local authority have published that because they were aware of this and have seen a drop in business rates, that actually they're passing a good proportion of the difference onto individuals through our own personal council tax. So I suspect one way or another we will end up paying for this. As I say, that's me just having a moan. Non-essential retail and personal care grants. This wasn't something that either Owen or I could really understand, to be honest, particularly the haircuts and the hair salons. It's not something that we frequent very often. But as businesses reopen, the non-essential retail, which is obviously hoping to reopen, I think from about the 12th of April, can apply for a grant of up to £6,000. I think, as with all the other grants, that will be administered through the local authority, and we'll wait to see the application pages open for that. Again, further down the line, but once sort of personal care, hair and beauty salons, etc., can reopen, because they're seen to be, much trickier to make COVID safe, they can actually apply for larger grants of up to £18,000. Again, we're assuming that will come through the local authority and will be administered by them, as has been the case for the other grants that have been available during the year.
Right, time to pay. I think one of the things that's really surprised me actually has been the appreciation and the I can't think of the word I want. The appreciation and the facilitation provided by the government of people because of circumstances beyond their control struggling to pay their tax bills. So if you've got a personal self-assessment liability and you're still struggling to pay it, they've automated the time to pay arrangements, which used to involve ringing up someone who at HMRC who might have not had his cup of coffee in the morning yet, or had a row with his partner before he left for work in the morning. So it was always a bit hit and miss as to whether you could get them to agree to you paying your tax over a period of time. So I think in an effort to try and be fair and to help people, they've introduced an online process for this now to take us through the current period of difficulty, with people with a tax liability of less than 30,000 can apply online. It's easy to complete, and it allows you to spread your payment. But you have to set up a standing order so that they know they are going to get it, but that's not unreasonable, I don't think. The one thing which is a bit of a bind for us is that, again, we're having to say to our clients, I'm sorry, we can't help you with that. It's something you've got to do yourself, because obviously from HMRC's point of view, they can't accept a commitment from us that our client's going to pay. They want our client to make that commitment, and equally we can't create their standing order for them. Fuel and alcohol duties, unsurprisingly, duties on wines, beers, spirits have remained unchanged, which is good news for pubs and Scottish exports. Although I did hear someone who ran a pub chain on the radio last night saying, well, it's all very well freezing it, but don't forget, when you spend £3 on a pint in my pub, one of my pubs, I get £2 of that, and £1 goes straight to the government. So he was arguing that maybe we should see a differential between duty rates for pubs and for supermarkets, which I can see some sense in. Fuel duties are frozen and the planned increases have been scrapped. And because I mentioned it last year, I'll mention it again this year. Most of the red diesel changes are to go ahead as planned, which is restricting the number of users of red or agricultural diesel as we would know it. But I'm very glad to say, as we're still spending an awful lot of time on our narrowboat, well, in fact, all the time, they've withdrawn that restriction, and we can still split the duty we pay on our red diesel between what's used for propulsion and what's used for heating and hot water and that kind of thing. So that was a personal win for me. And I think we're finishing up with stamp duty. So the extension, as Ian mentioned earlier, I do feel sorry for conveyancing solicitors here. The extension to 500,000 has been extended until the 30th of June 2021. So I expect they're going to carry on working 15, 20-hour days and working over the weekends to get their property transactions through. Then there'll be an increased normal nil rate band until 30th of September, which will be double the normal nil rate band. So that will be 250,000. Could be useful for planning if you've got more than one property and you're liable to the 3% surcharge. So maybe if you've got a residential property that you're trying to get out of your name into a limited company, you could get in while these extensions are in place, and you'll still get hit with the surcharge, but it will be less than what it would have been once the rates revert to normal.
Absolutely. And then I think the only other point to add, stamp duty is one of those taxes that historically was dealt with by the solicitors. But again, with all of these changes, you can see that it's becoming more and more complicated. And increasingly, we're seeing stamp duty fall within our remit, and the solicitors actually saying, can you give us a hand with this or that, particularly where it's a slightly unusual case. And I've seen a number of clients recently who have purchased farms, and they then get bombarded with letters from, I would say, sort of ambulance chasing firms that will say that the purchase looks like it should be eligible for certain stamp duty reliefs. Would you like us to help you reclaim that on a no-win, no-fee basis, but clearly quite hefty rates of commission if they are successful? And I would just say, just be very careful on those. The revenue are aware of the relief schemes. They're providing clarity very regularly. And actually, we've seen quite a few where these letters have been received that actually just don't qualify at all. So you can save yourself the time and effort, and just be wary of those if they do land on your doorstep. Then just a very, very brief roundup of the rest, really. The other things that were announced yesterday. We've got the mortgage guarantee scheme. So that's effectively the reintroduction of 95% mortgages, allowing people with a 5% deposit to get onto the property ladder. I think time will tell as to how good an idea that is. Things are still quite fresh in the mind from 2008 when 95 and 100% mortgages obviously sort of went pop. So just need to be quite careful with those, I think. The recovery loan scheme, that really sounds as though it's a new name. It's a rebadging of the current CBILS, Coronavirus Interruption Loan Scheme. It's 80% backed by the government. There are going to be some accredited lenders that can do this, but details on those are to be confirmed. I believe applications open in April, and it's a mixture. You can either apply for term loans and or asset finance. I think what will be interesting to see here is, as you go through the application process, what parameters are set out by the lenders that you have to meet, because speaking from experience going through the CBILS process, it's there because people have been adversely hit by COVID, but that isn't always taken into account. And I've had some difficulties with some clients actually obtaining CBILS funding because the banks don't appear to have been as understanding as I thought they might be, particularly given that it is 80% backed. There was a large fund announced for arts, culture and sport, and then a few points on free ports and the infrastructure bank. Did you want to say anything on those, Owen?
Well, I think they announced the free ports. There was quite a lot of chat about them on the radio this morning. I wasn't going to say a great deal about them because they're not on our doorstep anywhere near really here. So I think if anyone's got any questions about those, pose them to us and we'll do our best to find out for you.
Absolutely. And likewise with the infrastructure bank, there's limited details on that at the moment, isn't there?
Yeah. So I think that's another wait and see really.
Absolutely. So I think that concludes everything that we had on the webinar for this time. So we'll move over to the questions and answers. I've got the questions open here, Owen. Are you happy if we just perhaps work our way down? There's 4 or 5 questions here.
Yeah, fire away.
So one for you, I think, and you may have already sort of answered it. I'm not sure of exactly what point it came in. With the corporation tax increases, we've had a question: what will happen for businesses making profits between 50,000 and 250,000? Are there going to be stepped increases?
Yes, it will be a stepped increase. Effectively, it will be a calculation which will phase the rate you pay between the current 19%, which will continue to apply for profits of 50,000, and the new rate of 25%. But I haven't seen the mechanics of how it will work yet, but I'm assuming it will work pretty much like the old marginal rate worked, which means that once you go over 50,000, and when you're in that marginal rate, the rate, although the overall rate you pay is less than 25%, the rate you're paying in that marginal bit is actually more than 25%. So if you're close to the 50,000, or you think you're going to be close to the 50,000, we may be going to be wanting to do some planning to get a pension contribution in, or to buy a piece of kit just to keep you below.
Absolutely. So I've had one that's are the self-employment income support scheme parameters exactly as they were for the previous rounds? I think that the short answer is yes, largely. The one key change is that rather than having to have filed an 18-19 tax return by, I think, the 30th of April 2020, they're now saying as long as you'd filed a 19-20 tax return by the midnight on the 2nd of March this year, that you should now be eligible. So it widens it up to people who are newly self-employed and have perhaps only actually just filed their first year self-employment accounts.
I think the only other significant difference is with the 5th one, Ian. There's your profit has to have.
It's turnover, isn't it? It has to have dropped by 30%.
That's it. Turnover has to have dropped by 30%. If not, you still get something, but again, it's reduced down even further. So
absolutely, absolutely. Interesting question here, Owen. Does the 130% capital allowances apply to cars bought in a limited company, which, especially if the electric car benefit in kind rates stay at the 1% that they've confirmed for 22 and 2% for 23, etc.?
That is an interesting point. I think we'll have to get the details of that individual and go back to them.
I think we will, and obviously they've made reference to the electric car point there, but I don't think they're just talking about electric cars, and clearly it depends on private use and all sorts of things. So yeah, we'll pick that one up separately. This one, I have to admit, I haven't seen anything. Somebody's asked, I don't think there was any change to CGT on business sales into employee ownership. I certainly didn't see anything.
I can't remember. There was so little on CGT. I think we would have noticed it. I think the only things I saw on CGT were the freezing of the rate and an introduction of a very bizarre, not bizarre, but a very restricted in its application, restriction to the availability of holdover relief for gifts of business assets where the owner of the limited company was a non-resident. So I'm sure had there been any change, we would have noticed it, because it wasn't in any of the press releases.
No, I'm glad you said that. I hadn't seen anything, so I think we're both on the same page there. And then finally, and this was a question that had come in quite early in the seminar, so I think you've now covered it. It was there any news on the implementation of IR35? Only really that it's going ahead as planned, and as you said, they've tweaked the technical advice such that umbrella companies now fall out, or people who are using umbrella companies, I should say, now fall out, because the slight technical tweak said that if the payment from the contracting party had already been subject to full PAYE and national insurance, then you couldn't be caught again. So yeah, absolutely. But there was no other news on it outside of that. And I think, have we got anything else? I think there's a question just come in that I'm not sure. I think we're going to have to pick it up. It's about if a company makes £100,000 of profit, or say £200,000 profit, what would the actual corporation tax be in each case? And my mental arithmetic isn't good enough to do that. Sadly, the way that it works is as soon as you've got profits in excess of the 50,000 profit threshold, we then have to start looking at marginal calculations, and there will be marginal fractions that will be released by the revenue, or that's how it always used to work, which then means that as you get closer and closer to the 250,000 threshold, you effectively get closer and closer to paying 25% rate of tax. So we could give you an estimate that you know, 100,000 would probably be nearer you'd be probably paying 21, 22%, and 200,000 you'd probably be paying 23, 24%. But the actual rate that you pay gets rounded to 2 decimal figures, or it always used to. So it isn't just, sadly, it's not a straightforward answer.
Yeah, I just tried to have a quick Google, and I can't see that they've published the marginal rate calcs yet.
Was there any change to the insurance premium tax? Not that I saw, I must admit, but I will pick that up separately afterwards. Similarly, any news or changes for buy-to-let landlords? Again, not that I saw, Owen, only that if they were thinking of doing some planning, then this extended stamp duty nil rate band might be of some use.
Yeah,
but nothing to punish them further. And I think finally there are a couple of people who are interested to know about the electric vehicle and the potential 130% tax benefit that we've already discussed. So I think what we'll do, Owen, is if you and I check that, and we'll give the wording to Maria, and she can perhaps just add that on when she sends the slides out.
absolutely.
That's probably the easiest way of dealing with that. So that's all the questions we've had. So I think all that leaves us to do is to say thank you very much for attending. Been a really positive turnout. Assuming most people are working from home, I wish you a safe trip from your office to your kitchen.
Yep, thank you very much for coming, and hopefully we'll be able to be back in the real world next time.
Absolutely. Take care. Thanks, everyone.
Bye.